Hello everyone, and welcome back to the channel. If you are watching this from the United Kingdom and you are a senior who has worked hard your entire life to build something for yourself and your family, I want you to stay with me for the next few minutes because what I am about to share with you could genuinely change the way you think about your property, your pension, and your financial security during these uncertain times. Before we dive in, if you find this information helpful, please do hit that subscribe button and ring the notification bell so you never miss an update that could affect your retirement plans and your property decisions. Your support means the world to us, and it helps us continue bringing you the most important news about the UK housing market. Now let me talk to you about something that is affecting every single homeowner and potential buyer across the entire United Kingdom right now. The property market at this very moment is making a massive gamble. And that gamble is that borrowing money will continue to get cheaper and cheaper. Let me take you back to 2022 when everything changed. Do you remember the chaos of that mini budget under Liz Truss? I know many of you do because it sent shockwaves through the entire housing market. Mortgage rates shot past 6% almost overnight, and the housing market practically froze solid. People could not sell their homes, buyers could not afford to purchase, and millions of families across Britain were left wondering what on earth was going to happen next. Since that terrible period, we have seen rates coming down gradually through 2024 and now into 2026. In recent months, this decline has picked up speed quite dramatically. The major lenders are now fighting tooth and nail for your business. HSBC, Nationwide, Barclays and many others have been slashing their rates multiple times trying to attract borrowers. Some of the smaller specialist lenders are now offering rates as low as 3.4% if you have a 40% deposit. Now I know that sounds wonderful, but please stay with me because there is much more to this story that you need to understand. Let me explain what this rate war actually means in real terms, because I think it is important that you understand the numbers. If someone borrows £300,000 at 6% interest, they are paying roughly £2,000 every single month just on their mortgage. That is a huge amount of money coming out of their household budget month after month. Now if that same loan is at 4%, that monthly payment drops to about £1,400. That is a saving of £600 every month, or £7,200 over the course of the year. When you put it like that, you can see why buyer demand has increased so dramatically. People who simply could not afford to buy a property at 6% can suddenly see a pathway to home ownership at 4%. The financial markets are currently betting that the Bank of England base rate will be around 3.25% by the end of 2026. This expectation is built into absolutely everything. It is built into mortgage rates, property valuations, buyer decisions, and the risk models that lenders use. Estate agents across the country are telling buyers that rates will keep falling. Sellers are pricing their properties based on the assumption that buyers will be able to afford more as rates continue to decline. Developers are planning new housing projects assuming that strong demand will continue for the foreseeable future. From individual first-time buyers to massive institutional investors, everyone is making decisions based on this assumed pathway of falling interest rates. Here is where I need you to pay very close attention because this is where things get concerning. There is a growing gap between what people expect to happen and what might actually happen in reality. The Bank of England has been sending signals recently that suggest they are far less confident about continuing to cut rates than the markets seem to believe. If the bank disappoints those expectations and does not cut rates as much as everyone is assuming, the entire property market will see why they will collapse almost immediately. So the Bank of England can only cut interest rates if inflation stays under control. And here is the problem that keeps the policymakers awake at night. Inflation is proving to be far more stubborn and sticky than anybody expected. Yes, the headline inflation number has come down from those frightening peaks above 10% that we saw in 2022. However, when you look at core inflation, which strips out the volatile food and energy prices, it remains elevated at around 3.4%. That is still well above the bank's target of 2%. The service sector inflation is particularly worrying and sits at around 5% as of January 2026. This reflects the fact that wage increases are feeding through into the prices of everything from getting your hair cut, to eating at a restaurant, to paying for professional services. The Bank of England has been very clear that they focus primarily on core inflation and service sector inflation when they make their decisions about interest rates. Both of these measures are telling them that the battle against inflation is far from won. Average wage growth across the UK economy is running at about 5.2% annually. While workers are understandably celebrating these pay rises after years of seeing their real purchasing power decline, this wage growth against inflation pressure limits how much the bank can give into interest rates. Higher wages mean higher costs for businesses, and those higher costs get passed on to consumers as higher prices. This creates a wage price spiral that central banks fear deeply because it makes inflation self-sustaining and very difficult to control. The Labour government's budget announced significant increases in public spending, including substantial pay rises for public sector workers and major investments in infrastructure. The Office for Budget Responsibility estimates that these measures could add 0.5 percentage point to inflation over the next 2 years. While this spending might boost economic growth in the longer term, it adds demand to an economy that is already running quite hot. When governments stimulate the economy through spending, central banks have less room to stimulate through cutting interest rates without overheating everything. This creates a fundamental conflict between what the government wants and what the Bank of England needs to do. The government wants growth through spending. The bank wants to control inflation by keeping rates higher. Something somewhere has to give. We also need to remember that the Bank of England does not make its decisions in isolation. Global economic developments increasingly limit what they can do. The Federal Reserve in America has signalled that it will keep rates higher for longer than people previously expected. US inflation has proven persistent, and the Fed is putting inflation control ahead of trying to stimulate growth. If the Bank of England cuts rates aggressively while the Fed holds steady, the pound weakens significantly against the dollar. A weaker pound makes imports more expensive, which directly feeds into inflation here in the UK. We import substantial quantities of energy, food, and manufactured goods that are priced in dollars. Currency weakness translates directly into higher prices for British consumers at the supermarket and at the petrol station. Global trade policy has become increasingly unpredictable, with major economies putting tariffs and trade restrictions in place. These policies increase costs throughout supply chains, and those costs eventually show up in consumer prices. The UK's post-Brexit trade arrangements remain complicated with ongoing negotiations affecting everything from agricultural imports to financial services. Trade uncertainty creates inflation risks that make the bank nervous about cutting rates too quickly. Global energy prices remain volatile because of geopolitical tensions and uncertainties about production. While energy prices have come down from their peaks, they remain elevated and could spike suddenly at any time. Energy costs affect inflation both directly through your household bills and indirectly through business operating costs. Now let me explain what all of this means for property prices, because this is the heart of what you need to understand. The entire property price surge we are seeing right now depends completely on continued interest rate cuts. If those cuts do not happen, or worse, if rates have to go back up again, the consequences for the housing market are severe and immediate. Current buyer demand is based on the assumption that borrowing costs will keep falling. Many buyers right now are stretching themselves to the absolute maximum they can afford based on current rates, because they expect that when they refinance in 2 or 5 years' time, rates will be even cheaper. If rates stay where they are or go up, these buyers face severe payment shocks when their fixed rate periods expire. Someone who can barely afford their mortgage at 4% simply cannot afford the same property at 6%. This creates forced selling, as overstretched buyers cannot refinance and cannot maintain their payments. When forced selling happens, it floods the market with properties for sale just as buyer demand is collapsing. We saw this exact pattern play out in 2022 when rates spiked after the mini budget. Transaction volumes collapsed by nearly 30% within months. Sales that were already proceeding fell through as buyers lost their mortgage offers or suddenly could no longer afford the properties they were trying to buy. Estate agents reported property chains collapsing throughout the country. Buyers who had already sold their existing homes found themselves stuck in temporary accommodation as their onward purchases fell through. The The current rally is creating exactly the same fragile conditions. Chains are getting longer as activity increases. If confidence evaporates suddenly, those chains will collapse simultaneously. The impact varies dramatically depending on where in the country you live. London and the southeast, where property prices are highest relative to local incomes, face the most severe affordability constraints. Even small rate increases can price out substantial numbers of potential buyers. Northern regions and Scotland, where prices are lower relative to incomes, have more of an affordability cushion. However, these regions also tend to have weaker economic fundamentals and lower wage growth. A national rate increase affects different regions in different ways and could potentially create a fragmented market where some areas boom while others go bust at the same time. Buy-to-let investors are facing particularly severe pressure right now. Mortgage rates for investment properties typically sit 1 to 2 percentage points above residential rates. At current levels, many buy-to-let mortgages are carrying rates of 6% or higher. Rental income growth has not kept pace with these mortgage cost increases. Many landlords are actually operating at negative cash flow, effectively subsidizing their rental properties from their other income or savings. If rates remain elevated, more landlords will try to exit the market. However, they cannot sell quickly because buyer demand is constrained by the same high rates that are affecting their ability to refinance. This creates a standoff between buyers and sellers where nobody can agree on acceptable prices and transactions simply do not happen. Property markets are driven as much by psychology and confidence as they are by economic fundamentals. Confidence can shift suddenly, and these shifts often become self-fulfilling prophecies. Estate agents are already reporting some concerning patterns. While viewings and inquiries are up, serious offers remain below peak levels. Many buyers are running the numbers and realizing that their affordability depends entirely on rates continuing to fall. Some buyers are explicitly saying they will wait to see whether the predicted rate cuts actually happen before they commit to buying. If enough buyers adopt this wait-and-see approach, it could become self-reinforcing and slow the market dramatically. Sellers are pricing their properties based on recent comparable sales and optimistic forecasts about the future. However, these asking prices assume that buyer affordability will keep improving. If buyer demand stalls, sellers face difficult choices. They can either reduce their prices to attract buyers in a weaker market, or they can withdraw their properties and wait for better conditions. Either choice reduces transaction activity and undermines price growth. We should also remember that media narratives about property shift very rapidly. 18 months ago, the headlines were screaming about falling prices and market collapse. Now the headlines are celebrating surging demand and rising prices. These narratives have a powerful influence on behavior. Buyers fear missing out during positive cycles, and they fear catching a falling knife during negative cycles. A shift from positive to negative narrative can happen within just a few weeks and fundamentally alter how people feel about the market. The current market dynamics create clear winners and losers depending on timing and individual circumstances. Anyone who bought property in the past 6 months based on current rates and expectations that rates will keep falling faces significant risk. If rates do not decline further, or if they increase, these buyers may find themselves in negative equity or unable to afford their mortgage when they need to refinance. Lenders are supposed to stress test borrowers to protect against this, but stress tests assume normal economic conditions. If inflation remains elevated and rates stay high for an extended period, those stress test assumptions break down. Buyers with substantial cash savings, or those who are not dependent on mortgage financing, can potentially capitalize on market volatility. If prices fall because affordability constraints affect mortgage buyers, cash buyers can purchase at discounted prices. However, even cash buyers face risks if prices decline substantially after they purchase. Property is not easy to sell quickly, and selling during a downturn often means accepting significant losses. First-time buyers face the most difficult decisions of all right now. They are being told that now is the time to buy before prices rise even further. However, they are also the most vulnerable to rate increases because they typically borrow the maximum amounts possible with minimal deposits. Many first-time buyers are choosing to wait despite the current lower rates because they sense that the market is fragile. This caution may prove to be very wise if conditions deteriorate. Homeowners with significant equity and low fixed-rate mortgages are well insulated from most of these risks. They can afford to wait out market volatility and only transact when conditions favor them. However, homeowners who need to move because of job changes, family circumstances, or other reasons face difficult markets regardless of broader trends. Beneath all of this speculation about rates and market psychology lies a fundamental problem that affects everything. The UK simply builds far too few homes relative to population growth and household formation. The country adds approximately 220,000 new homes annually, but needs at least 300,000 to keep pace with demand. This shortfall has accumulated for decades, creating a structural supply deficit that no amount of monetary policy manipulation can solve. Planning restrictions, land availability, infrastructure constraints, and construction industry capacity all limit how quickly supply can grow. The housing supply problems are most acute in exactly the places where demand is highest. London and the South East have the worst supply-demand imbalances, but also the most restrictive planning environments. Northern regions have more adequate supply but weaker demand because of economic fundamentals. This creates a mismatched market that cannot correct itself without significant population movement or economic rebalancing across the country. Until housing supply increases substantially, UK housing will remain structurally unaffordable for most working people. Rate cuts provide temporary affordability improvements, but these improvements evaporate quickly if rates rise again. The only sustainable long-term solution is dramatically increased housing construction, particularly in high-demand areas. This requires planning reform, infrastructure investment, and political will that has unfortunately been absent for decades. So where does all of this leave us? UK house prices are indeed likely to rise in the near term. Falling mortgage rates have transformed affordability calculations and unleashed pent-up demand from buyers who were completely priced out of the market for the past 2 years. Estate agents will be busy through spring 2026. Prices will probably rise in most regions. Headlines will celebrate the property market recovery. But here is the crucial catch that makes this rally different and potentially dangerous. The entire surge is built on assumptions about future rate cuts that are far from guaranteed. The Bank of England faces conflicting pressures from sticky inflation, government spending, global economic uncertainty, and currency considerations. If the expected rate cuts do not materialize, or if rates actually have to rise to combat inflation, this property rally does not just slow down, it reverses sharply and potentially traps buyers who borrowed maximum amounts based on optimistic assumptions. The UK housing market in 2026 sits at a genuinely dangerous inflection point. Prices may continue to rise if conditions align perfectly, or they may decline significantly if rate expectations prove wrong. Anyone entering this market right now must understand that they are making a highly leveraged bet on interest rate policy over which they have absolutely no control. For those of you who are seniors looking at your property as part of your retirement planning, please think very carefully before making any major decisions. Consider speaking to a qualified independent financial advisor who can look at your specific circumstances. Do not let anyone pressure you into buying or selling based on predictions about where rates are heading because, as we have discussed, nobody really knows for certain what will happen. Thank you so much for watching today. If you found this information valuable and you want to stay informed about how the UK property market affects your retirement security, please subscribe to our channel right now and turn on notifications so you never miss an update. We are here to help you navigate these uncertain times with clear, honest information. Until next time, take care of yourselves and your families.